the way you calculate earning per share is in its simplest form, just like the name suggests, income divided by shares. Now income is net income minus preferred dividends divided by the weighted average common share, and this is, if you want, where the trick is like, how do we calculate the weighted average common shares in different scenarios? So you have two main scenarios. For example, new shares are issued. For example, new shares have been issued on the 31st of or the 1st of April. So how do we count those shares? Well, we don't count them for the full year. We count them only from the issue date. So their weight, let's say it was 100 shares, would be 100 times 9 out of 12. But if it's a stock split or a stock dividend, even if it happened on the 25th of December, you will treat it as if it happened on the first day of the year or the period. So you will restate everything from 1st of Jan. So you will consider, let's say it was a stock split 2 to 1 share became 2, then the whole year will be considering that you had 2 shares and not 1 share. Now the really interesting part, or the difficult part, because this is quite straightforward, is the diluted earning per share. And here we are in the what if scenario. What if dilutive instruments were converted into equity? For example, convertible debt, stock options, warrants, and at that point you need to adjust both the numerator and the denominator. Why? Because if suddenly you convert a debt into common shares, then you're no longer paying the interest on this debt, right? So the numerator, the net income, change. But the denominator, the shares, also change, because now you suddenly have more shares. Now you have different cases. For example, stock options, they do not generate interest or dividend, and they only change the share count. So in the case of, again, stock options, the company will receive cash from the holders and then will use that cash plus more to buy the shares back in the market price, but there will be no change on the numerator. It will just be new shares in the denominator. In the case of convertible debt, there is a change in the numerator, as we said, and what you have to remember is to think of the interest net of the tax, because you do save that tax expense when you're paying the interest. So always keep this 1 minus t being the tax, in your head when you're thinking about income adjustment for debt. Now, without again going into too much detail, one important rule that you need to remember is that you're not allowed to include instruments that would make the earning per shares look better. And that means in the diluted EPS that if the EPS, diluted EPS goes up instead of down, then it means that the instrument is anti-dilutive, and therefore you must exclude it. So in practice, you would test the potential dilutive effect of each instrument one by one and remove every time it's anti-dilutive, and maybe you remove them all and you end up with a diluted EPS that is exactly the same as the basic EPS. But the rule is diluted EPS can never be higher than basic EPS.